The economy is strong, and it's stronger than we thought it was going to be in September. So the labor market is better, and the downside risks appear to be less in the labor market. Growth is definitely stronger than we thought, and inflation is coming a little higher. So the good news is that we can afford to be a little more cautious as we try to find neutral.
That was Federal Reserve Chair Jay Powell at the New York Times Dealbook Summit yesterday. Joining us right now on Powell's comments is former Cleveland Fed President Loretta Mester. She's now an adjunct professor at finance at the University of Pennsylvania's Wharton School, also a CNBC contributor. And Loretta, what did you think of Jay Powell's comments yesterday? This idea that maybe we have a little more room, maneuverability, and not necessarily have to be in any rush on this.
I mean, Becky, first, Andrew, congratulations on the interview. It was nice to see you got some of Jay's personality coming out in a way that we don't usually see in interviews. You know, what I heard, Becky, is basically the basic narrative that the Fed wants to, as the economy is normalized, bring interest rates to a more normal level is still intact. And I think he's right. If you look back at when they started to reduce rates in September, right, they were clear that they had more confidence now that inflation is going back to 2%. And they did, that was why they cut rates and began the cutting cycle. But they did 50 because I think they were worried about the downside risk to the employment part of the mandate. And what's happened since September is the data has come in. Some of that concern about the labor market went away with the revisions in the data and subsequent data. And some of the inflation readings have been a little bit firmer than they would have liked to have seen. But that doesn't change the basic narrative that the economy is normalizing. They want to bring rates into a more neutral stance over time, if that continues to be true about the economy. And I think that's what I heard him say. And yes, given the change in the risks, a little more, upside risk on the inflation part of the mandate and a little less downside risk on the employment part, it makes sense that they can go more gradually now. So my expectation is that, they'll have the discussion at the December meeting. Of course, there's more data coming in. As you just mentioned, we're going to get the employment report tomorrow. We're going to get inflation, the CPI inflation report next Wednesday. And those will be important data really to assess against that narrative of things moving into better balance and, really trying to balancing the risk to both parts of the mandate. And that's where they are now. And I think that's what they're going to want to try to do. They really want to keep the interest rate, their policy rate, and monetary policy overall in a really good position so that no matter how the risks manifest themselves, they're able to react in an appropriate way. And I think that's the sort of what path they're on now, is to try to bring rates down. And there's room to...
Oh, go ahead. There's room to...
Yeah, there's room to do it because even though there's uncertainty about where neutral is, if you go back and look at sort of what the Fed's own projections of the long-run funds rate is, there is quite a bit of diversity of views around that in the last SEP, but they're still well above that, even the highest estimate of neutral. So I think there's room to continue on that path. They're just going to be a little probably more gradual than they might have thought they were going in September over time.
That all makes sense perfectly from anybody who's following along closely. But you are going to hear, and we have been hearing, calls that accusing the Fed of being politically motivated by this, saying, OK, you were all in favor of lowering rates when it was President Biden and Kamala Harris who was running for election. As soon as President Trump was elected, then the Fed's stance changed. And again, anybody who's watching along knows that what you just laid out makes perfect sense. What do you do, or what does the Fed do, in order to try and protect itself from those accusations from people who aren't following along quite as closely?
Well, I think he did what Jay Powell did yesterday, which just explained the rationale for why the Fed's making its decisions. I mean, the Fed is not a political organization, and it's never made its decisions based on the politics of the situation, at least in my tenure there over the last 35 years or so. And so it really is, you've got to explain to people and come to them where they are and explain sort of why you may be going a little slower than you thought. The basic narrative hasn't changed. They want to bring rates down to a more neutral stance, given where they project the economy is currently and where it's going. And, they're going to have to play risk. As you were talking about earlier today, the fiscal situation, policy situation, there's still a lot of uncertainty about that. And they'll have to learn more over time about what the policies are going to be, the magnitudes, and they'll be running those through models and talking to actual business people about, okay, how are you going to react to some of the, things going on the fiscal side? And I think that's an important part of actually talking to those businesses and talking to people about what are they hearing, what are they doing, how do they expect to react, so that the Fed then is in a good position. But a lot of it, Becky, is communicating, and a lot of it is what Jay Powell and his colleagues on the board and at the reserve banks are doing, was really trying to explain, like, okay, what's changed in the economy? What does it mean in terms of where they think the economy is going, the outlook, and what are the risks around that? And you have to be very attuned to risk either on the upside or downside to both parts of the mandate now. And I think they're trying to do a good job of that as they kind of walk back from having everyone sit around their computer terminal waiting for that next data release, and wow, that's going to change the outlook of the Fed. I think at this point they really should be focusing in on, they do look at a lot of data, they take all that in, and then they have to assess, well, what's changed given where we thought the economy was going with the new set of data that have come in. And I think that was one of the things I heard Jay do well yesterday, is try to explain, well, the last set of projections we gave out was September. He didn't say that, but that's what was true, and that's when they started moving rates down. What's changed since then? And the way I heard it, it was there's a bit of change on inflation, a bit firmer, less risk on the downside on employment. And so their risk balance may have changed, but the actual narrative about, we are in a good position to start moving down some of the restrictiveness, I think that was there.